Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question for Bill, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. So without any additional delay, here's the host of today's program, Bill Bullington.
And welcome back. Wow, what a wild week. Oh, you gotta love that. Unbelievable. So many things have happened in such a short time period. It's mind-boggling. It was one of the worst starts to a month in a very long time. And the number of down days in the market in a row hadn't been, it had actually just matched the numbers from 2008. Think about that for a second. And you get the surprise in market rallies. You know, go figure. That's why that's why I've said for a long time, I haven't always said that, just after I've been in the business for a few years and have observed an awful lot of things happening. Anything can happen. And probably will. So, anyway, we got a lot of really good stuff. Got a seminar coming up on Thursday night, and I don't think that it's sold out. It could be, because I can't check right now to see how many people are coming, but I doubt it. Anyway, don't buy a stock or a fund, be your own fund is kind of the theme. There's a technology out there that lets you basically create your own little mini mutual fund. It does it without regular commissions. It charges a flat fee, and you can trade all you want. How cool is that? They even buy fractional shares, so you can invest just like the ETFs. In fact, you can create your own ETF. Now, why would you want to do that? Why would you want to create your own ETF? I'll give you a really good reason. When I look at my scans this past week, there have been an enormous number of banking stocks, many of which do not show up except for an extremely small percentage of your major funds. And if you wanted to get a good exposure, the banking ETFs are okay, but they're overweighted in the super large companies, and the ones that are moving fastest are the smaller ones. And they are flying. Okay. So if you wanted to put together a portfolio of stocks, you could go to a firm like this company called Y-Charts. You could search for domestic, those are companies headquartered in the United States. Small banks, savings and loans that are publicly traded. Let's say they're below 4 times or 3 times annual sales, because that's a full value right there. And you could come up with a list of stocks, export it to a spreadsheet, import it to this firm. It's called Folio Institutional. And you could, with one click of the button, you can create a portfolio of those particular stocks. How cool is that? Now what you're doing is, instead of putting all your money on red, in other words, one stock, my luck is I pick the one stock that doesn't go up. That's what I would do. But you can take all of these companies and buy a basket of stocks with one click of a mouse, and it's much safer to do it that way. Particularly if you use a couple of criteria like what I just mentioned, a price-to-sales ratio not greater than 3. Actually, 4 would be, I'd go to 4. So price-to-sales ratio not greater than 4, and then you get an entire basket. You could buy up to 50 securities. And by the way, they will buy fractional shares, which means it'll buy a piece of a share. So you could do this with as little as $1,000 in that particular strategy. And it's just a really neat thing, and I think that you should take a look at it. Absolutely. That's what we're going to be talking about. And I have a couple of my favorite. And by the way, banking stocks make up about 10% of the portfolio. So I've been very happy with that this past week. It's been very, very positive. And but if you wanted to go a little further, you could do that. It's only limited by your imagination, and I'm going to show you how to use those tools. We're also going to talk a little bit about what's happening right now. Over the past decade or so, particularly over the past couple of years, what I've noticed is that stocks will move extraordinarily fast, and then the move is over, and it'll go back to sleep again, or start, worse, it'll actually go down quite a bit. How do you catch those moves? How do you participate in that if you wanted to? And I think I got an idea. I've got the plan. I'm going to talk about that too. I haven't talked about this before. It's a product called Telechart, TC2000. I've written and tested some code, basically. It's not really, I hate to call it code because it's nowhere near as complicated as writing a program. Real program, using a real programming language. So it's not that difficult, but this is pretty cool. And there are lots of stuff. More stocks have been coming up in the past 2 weeks than I've seen in the past 3 years. Think about that for a second. More stocks have come up in the past 2 weeks than I've seen in the past 3 years. And a lot of these companies are undervalued, which really helps out a lot. And now they're moving higher. I think we're really onto something here. And a large part of it is because the current perception is that this president is going to be business friendly. That's the perception. And a lot of businesses that were being held down, being restrained, or the perception was that they were being restrained by the last administration, is going away. A lot of that stuff is not going to be there going forward. So that's one of the reasons you're getting the bank stocks moving as fast as they are. And I'm telling you right now, a big part of that perception, you got all these little tiny banks all across the country. Share prices flying right now because with a reduction in the regulations is going to make it much, much easier for bigger banks to acquire those guys. So they are all targets now. You work for a small, medium-sized bank, there's a really good chance somebody comes knocking on your CEO's door saying, hey, we'd like to buy you. And that activity is going to speed up. That's why your smaller companies are moving faster than the bigger companies. Bigger companies have done quite well, by the way. It's not as fast as the smaller companies. So, and again, I'll show you how you can take advantage of that, both on the building a portfolio of stocks. I'm actually going to run that particular screen, and I'm going to give it away at the seminar. I'm going to show you how to do that. Now, remember, they're still stocks. Just because they're undervalued and their prices are moving up doesn't guarantee that they'll continue to move up. No guarantees. You're not allowed to do that in my business. Those people that tell you you've got guarantees, well, I got news for you. Yeah, they don't have securities licenses. so they don't care. They can say anything they want. But I do have a securities license, and I still want to be in business 5 years from now. So I'm going to play by the rules. Anyway, I'm going to hand that out. That's a handout. I'm going to show you how to do it. And in fact, you know what? The next day, I will actually, I'm going to put a piece of my portfolio, I'm going to take a piece of my retirement plan. That's my forever money. And I want to put a chunk of that in that particular strategy that I'm going to give out the little tiny banks that are running like crazy. How's that? So, and I'm going to give that list away, and you get an opportunity to open your account and invest ahead of me. So, by the way, I don't have enough money to push all those share prices up, so don't worry about it. But I think it's a good opportunity. It's a good way to learn about how funds actually work. When you're looking at this, you're looking at all the stocks within your portfolio. When you look at a mutual fund or an ETF, all you see is the net result of all the positions. You don't see the individual shares. Prices, and you don't see how they fluctuate. That is a phenomenal exercise. For a lot of people, it's a little spooky. It scares them. I like it. I like to see that. I like to know what's going on. Really helps out a lot. On top of that, at this workshop, the Lookout for the Bull website, we've started the process. It's probably going to be another 6 weeks out. That's the website where if you were to look at an individual name, like say, I don't know, Nordstrom, which I plan on trading on Monday morning. Right around 10 o'clock, I got to give you guys a little bit of lead. I don't have to give it 3 days. There's no rule saying I have to do that. Some of the bigger firms, that's what they do. But I don't have to. Anyway, Nordstrom comes up on a scan, and for all you William O'Neill followers, it's got a cup and handle pattern. It's coming up off of a bottom, and that is a classic cup and handle pattern. And it's not extended more than 5% above, well, actually a little bit. It is, hang on a second, I have to tell you. Since I brought it up. 6.96% above the pivot point, and I'm pretty sure William O'Neill has changed that rule anyway. This is pretty cool. Huh. That's funny. Telechart is constantly up. I just learned something new here on the air. They're constantly upgrading their software. That is one of the best tools for the amount of money that you spend on that. That is, it's amazing. And it's called, go to tc2000.com. I'm going to be using that at the workshop. Nordstrom's came up on that, which incidentally, here's what I'm looking for. I'm looking for a stock whose range is twice its average daily range, whose volume is 150% of its average volume, where it closes in the top 25% of that particular day's range. And it's already been going up pretty quickly over the past few months. So what am I looking at? I'm looking at, when I combine all those things together, what does that actually mean? What it means is I'm looking at a stock that's going up fast, that's accelerating. That's what I'm talking about. A strong stock getting stronger. And symbol on it's JWN. It's Nordstrom. If you don't know who they are, they're an extremely expensive retailer, which incidentally have done a lot better than the low-cost retailers have. It's down like they've all been down, but you look at their financial results, very strong. That part of that particular market, the retail market, has been very stronger than the other ones. Been kind of interesting. Watch that happen. Look around the country, the stores that have done the best in the malls are the more the more expensive ones. So anyway, by the way, if you'd like to call in and ask a question, 216-901-0945. That's the number here. My website's the website's Bullington Capital. My email address is bill@bullingtoncapital.com. And I'm excited. I think that a lot of things, I was kind of nervous. I'll admit it. I was nervous when Trump won the election. And now that I'm looking at who he's talking about, I was on the Bloomberg. I think I slept about an hour and a half on election night because I immediately started trolling Bloomberg. They have more journalists than the API does, Associated Press. You believe that? Yeah, more journalists than they do. So, and they're up on everything. So I'm trolling the headlines, watching the reports come in, and then I start seeing the names that they're mentioning that that might be interested in working with his cabinet and will actually some of the members of the cabinet. And I'm going, whew. He's got some pretty highly qualified people there. And with a lot of their agenda, it's going to be business friendly. It will be business friendly. Now, here's what I think could potentially happen. The odds are probably 50-50 on this. With most other odds, they're less than 50-50, most other scenarios. So this one I feel like has the better chance, and it's only 50-50. But that's okay. Any of you guys that know how to count cards know that you don't need to have odds in your favor to win, and win big. So here's what I'm thinking. A lot of regulations are going to get repealed. They're going to get pushed back. It's going to be much friendlier. It will actually help a lot of companies' bottom lines. If they go to a trade war, that's not a good thing. That would lead to all kinds of problems. The much higher prices is the biggest problem. When you're a billionaire, that doesn't really bother you too much. The price of gasoline goes up. The price of everyday household items that you bought, doubles over the next 5 years. You don't care. You used to pay $10 for a spatula at Bed Bath & Beyond. Now it's $20. You don't really notice that if you've got a whole lot of money. The people that do notice it are, everybody else. And but that that takes time. That takes a long time to work through the economy. I think if he stays away from that, I'm pretty sure the people that are close to him are going to tell him, and he'll understand that. I'm pretty optimistic that things are just going to go. A lot of things that have been held up, they're going to get done. That money gets spent in the economy. You do infrastructure spending like he's talking about. There's this thing called the multiplier effect. It's extremely beneficial. Now, and here's the scenario that I think is quite possible. I think over the next 4 to 5 years, you have extremely good growth. GDP growth rate has already started creeping up back above 3% again. That was before the election. And that keeps going on that course. I think there's a really good chance that it actually accelerates. Will they raise interest rates? Maybe a little. I really doubt that they're going to raise them a lot. I don't think you're going to see a 5 or 6% interest rate in the next 5 or 10 years, mainly because you still have $11 trillion of outstanding debt. You raise interest rates 3 or 4%, that's $300 or $400 billion a year that you have to pay. Okay, you can't go and renegotiate that, although Trump may try. That would be funny, kind of, not really, but that's what I see happening. I think that you're going to see a massive acceleration. A few reasons for that, by the way, not just because he's going to greenlight just about everything that anybody puts in front of him, but I think that the economy has been under there's this reversion to the mean concept that going back to average. That's what reversion to the mean means. For those of you that don't like to use a lot of 3 or 4 syllable words, getting back to average. That's what reversion to the mean means. Get back to average. Average growth rate's about 3.5%. And it is not like we can't use some new bridges, or bridges being repaired, highways. It's not like the grid doesn't need to be upgraded. It's not like the internet doesn't need to be upgraded. It'll get upgraded anyway because that's a lot of private money and it doesn't really rely that much on the government anymore. All these things need to be done. You need to get an EPA that's reasonable in a lot of areas. I talked to a lot of small business owners who just upset.
Hugh Hewitt reacts to an historic election.
The Supreme Court is saved. Not only does he get to make an appointment.
That was interesting. I guess we're getting close to a commercial break. So if you want to go ahead and play the commercial, that's fine. Listen, you're listening to Bill Bullington right here on 1420. Stay tuned because when we come back, we'll talk about some individual names that you might be able to make some money from. Man, isn't that some awesome music? Anyway, hey, if you have a question, feel free to call me, 216-901-0945, 216-901-0945. Sorry for the abrupt cut to the commercial break and the fumbling there, but so much is going on this week. Everybody's really excited, and I have to tell you, I was flabbergasted. I'm watching, the S&P futures are down 800 points. I keep hearing this 700-point number. That's wrong. They were down 800 points on the Dow. The Dow futures were down 800 points. The S&P futures were down around 5%, which is over 100 points. That's a big drop. And then by the time the market had opened, it had pared those drops down to about 2%. And at the end of the day, the market was positive. And I keep thinking there was this big hedge fund manager. I'm reading about him. I'm reading everything. Okay. My mind is racing, probably just like a lot of those portfolio managers. And there was this guy, super successful hedge fund manager. I won't name him by name because it's, everybody has days like this. Sometimes you have years like this. But he had to watch the Brexit. The Brexit caught him off guard. And he decided not to do that again. So this time, he lightened up on his positions. And he got short, meaning he was hedging the portfolio, expecting that, the Trump thing. And guess what? Goes the opposite direction again. Oh, man. It's hard. It's very difficult. And the reason I'm laughing is that happens all the time. And people think that the professional investors have a crystal ball that works. They don't. They sit there. They learn how to manage their losses is really what they do. They learn how to manage their losses and then put themselves in a position so that when one of their investments does pay off, it pays off big. That's the key. And if you look at all their track records, about 80% of their profits come out of less than 20% of their transactions. Think about that for a second. So does that sound like a crystal ball that works? 80% of your profits coming out of a very small number of your investments? And that's the typical investment manager. And it's the same way with the portfolios. I look at our high dividend model and I look at where the returns have come from over the years, and it's hilarious. I mean, They're companies that were probably the most unlikely when they started, especially when we first were adding them to the portfolio. I was just holding my nose and thinking, oh, geez, I have to buy it because it's the discipline that I subscribe to. Now think about that for a second. You have to do something that is psychologically uncomfortable for you. And if you don't have a lot of training, you're probably not doing that. I have a client I like very much. In fact, we're good friends, and I listen to him all the time, and I'm just like, wow, the guy, I know why he's smart enough to recognize that he wouldn't be able to make these decisions quickly enough to be able to benefit from them. And that's an extremely high level of intelligence, by the way, because he goes out and finds someone who will. And he understands it. And so when you really understand the money management process, it gets a lot easier. It really does. So what's really hard is people come into financial markets with preconceived notions. You come into the market with preconceived notions, I got news for you. Market's going to show you how it really works. And it's not the way you think it is, and it's going to be upsetting. That's why I do these seminars. That's why I do the educational meetings all these years, have done them all these years. Try to get you to the point you need to be able to be a good investor. You need it now more than ever. We've got incredibly low interest rates. They only have one way to go from here, and that's up. When interest rates go up, bond prices drop. So everybody's been piling into bonds, trying to get a little bit of an extra yield. At some point in time, that's going to be incredibly difficult to maintain. And I'm looking at the bond prices over the past week. Boy, those have really dropped. High yield bond index down about 4% over the week. And it's moving opposite stocks, which is kind of wild. Aggregate bond index, that's the one that everybody's been touting. It's beaten 90% of everybody. It's down 3.4% from its high. By the way, the yield on it wasn't even 3%. So now you got a 1 year return that's minus, that's negative. And what John Bogle says is the right way to do. I give a crap what John Bogle says. The guy, he needs to get quiet. He's hurt too many people, and he won't admit it. He gets angry about that. And I think he's probably a little bit of dementia sitting in there. Quite frankly, I think it started when he was about 35. Just kidding. But anyway, when you do things that hurt a lot of people and you don't apologize for it, and then you keep stamping on, you don't change your story. You just pick the facts that support your story, ignore the ones that don't. And I'm not a big fan of those type of people. I am a big fan of people like Warren Buffett, whose stock, by the way, has been doing very well throughout all this. In fact, it reached an all-time new high. The stock just reached an all-time new high, which is pretty impressive, given the long-term performance on that. Just mind-boggling. You can buy shares in his company too. By the way, they've got the smaller class. The Class A shares are $234,000 per share. Per share. I remember people just chastising me, telling me, literally, people swearing at me over the phone. Back in the early 90s, when I used to try to get them to buy some shares at $5,000 a share. It's $5,000 a share. Have you lost your mind? No, I'm telling you. It might have been actually in the 80s. Now that I think about it, probably was. But it is what it is. In fact, let me see here. When was that? Yeah, it was early 90s. My memory's better than I thought it was. $5,000 a share for one share, and couldn't get him to buy it. It's not that stock rarely gets undervalued. By the way, it rarely gets undervalued, and it's probably slightly undervalued right now. But it's not one of those stocks that it's going to zip up a couple 100% in a month or two. That's just not going to happen. But it's a very well-run company, and Warren Buffett, at some point in time, he's made a lot of arrangements for that company. I think it probably does very well after he's gone. But what are you, as an individual investor, somebody who's coming up for retirement, what are you thinking about? What do you need to do? What do you need to prepare for? Well, actually, there are quite a few things. The two biggest risks to the average investor coming up to retirement is our health care, and the second one is running out of money. I would say running out of money is probably a result of having to pay an awful lot for health care. It's a huge contributor. Huge contributor. So those two things kind of work hand in hand. But running out of money, if you're not investing well, and this is why my heart really goes out to the general public, because it's not good enough to be an average investor anymore. You've got to be above average if you expect to have a retirement of 20 years and not run out of money. You have to be above average, which is not easy to do. By the way, everybody thinks they're above average. Well, that's impossible, because when you add them all together, there is an average. There's a really good chance that you're not above average. And if you look at how you're doing, you've got to be above average. By the way, the average investor really doesn't do very well. The average investor deludes themselves as to how they're doing. I see it. I hear it all the time. Not really interested in even talking to them anymore. But so if you don't want to be an average investor, you need to know the kinds of things that we teach at the seminars. You need to know that. And we are putting up, we made this thing, actually, this guy does all the trading for Bullington Capital because he's got nerves of steel. That's literally how I picked him. This guy is ornery, but he's a really nice guy. Puts his mind to something and is going to get it done. That's how it works. And he actually had a very interesting career, and he made this light board for us this week where I can stand, it's a pane of glass, and you write on it with these neon markers, and it's LED lit around the edges, so it makes the writing pop, like it glows. And you record that. Now, if I'm standing on the other side of the glass and I'm recording it, to you, it's going to look backwards, right? The writing's going to look backwards. Maybe not that helpful, except when you use Final Cut Pro or any actually video editing software, and you flip the image, now it looks like you can see, it's regular writing. You're seeing what I'm seeing. And how cool is that? So we'll be able to take a lot of these ideas. None of them are extremely complicated. Investing is a lot simpler than people make it out to be. Anybody that's confusing you with data, I would say, you might want to find somebody else. It is fairly simple. One of the challenges I face sitting down with somebody new, sitting down with a new investor who's new to me, rather, and has gone through and has heard all the stuff that's out there. One of the challenges I have is that mine seems so simple that it's too simple to work. That's the challenge. That's my biggest challenge. It is so simple that it just can't work. Really. You need to talk to some of my long-term clients. And it's not perfect. And it doesn't work the way that the average investor wants it to. They want things to just go up and never go down. That is never going to happen. I don't care who you are with. And the equity indexed annuities, I'm going to tell you right now, there are an awful lot of companies out there. They're just flat out lying. They're just flat out lying. You got an annuity product. There are some good ones. There are some good ones. But there are a ton of bad ones. Bad actors. Those companies are going to end up going away one day. And when they go down, just like the other big insurance companies did, you're going to see just how valuable their guarantees are. The guarantees are only as good as the companies behind them. So if you want us to do a comparison for you, I'll be glad to tell you. And I know there are lots of products out there that are good products. There are a lot of products that aren't. And by the way, if you've got kids, I just read this. If you have kids that are getting ready to go to college, when you have when you're filling out the federal aid form, the FAFSA, financial aid for students, the federal financial aid form, if you have money in an annuity, you don't have to report those assets. At least that's my understanding. That's my understanding today. And I just double checked that. So I could still be wrong. That's the thing about today and having the internet in all these sources, all these experts. You can do an awful lot of homework and still find out that the answer you got wasn't right. But it appears as though that wouldn't count. So what do? And and incidentally, the other thing that's interesting is if you have taxable assets and your kids are going to college, they're only going to count like 5% of your taxable assets towards contribution to the kids' college, which is not a problem if you only have one or two kids. If you got 8 or 9, that could be a problem. because you basically have to go broke before you'll qualify for any financial aid. But that's kind of a big deal. Just a tax deferral alone, and things you can bet that the capital gains tax isn't going up anytime real soon, and they're going to stretch it out the holding period to 6 years. That was the thing that Hillary had put out there that I was like going, oh, geez, that's rough. But anyway, that's not going to happen. You might want to look at the investment only annuity because the tax brackets are still pretty high. Even if they aren't, that's a big deal. Not having to report all that stuff on it, getting a 1099. So I guess to make a long story short, we've got a service where if you already have an annuity, we'll compare it. We'll show you what you've got. We'll show you whether or not you can improve it, how you might improve it. Or if you've got a good product, I'm going to tell you, you've got a good product. You should stay with that. And that's about the best that we can do. So feel free to contact us over that. And I did get a call this week, and I really appreciate this. A guy called. He was worried about Genworth. I talked about them, having a takeover bid from a Chinese company. And he's got a long-term care policy with them and was concerned about it, rightly so. And I told him what I know, and I will look into it a little bit further, actually. I know it's that's one of the areas that it is really tough to deal with in retirement. If you end up spending some time in a nursing home, they're expensive, really expensive. And unfortunately, you won't qualify for Medicaid, which is the government program that typically pays for that. Medicare doesn't pay for nursing home care. So the Medicaid program, you've got to be essentially broke, before you can qualify for aid. And, if you've saved up a couple $100,000 in assets, maybe $1 million, do you really want to be spending $10,000 or $15,000 a month on nursing home care? That's such a tough situation. But anyway, and now that I'm getting a call, I forgot that to give out the number, 216-901-0945, if you'd like to call in, 216-901-0945. And I see the message coming across here. And Jerry, you have a question for me?
Hi, Bill. Curious, I got a fairly nice whole life insurance policy. I got a fair amount of cash value. I'm 65 years old. What's the recommendation at this point? Keep it intact, or
do you have kids?
Go into annuities, or
Do you have children?
Yes, but they're out of the house.
Do you have any outstanding debt?
Not significant, no.
Okay, so this is basically just a policy that would be nice for them to have.
Well, it would be. I mean, there's enough money regardless. But I'm just curious from the standpoint of return.
Here's something that you could do. You could actually do. Actually, we're going to have to go to commercial break. Can you hang on?
Sure, of course.
All right, thanks. You're listening to Bill Bullington right here on 1420 The Answer. Stay tuned because we'll be back after these messages. Back. Hey, Jerry, you still there?
Yes, sir.
Hey, one of the things that you can do with a life insurance policy, it's called a 1035 exchange. You could actually roll that into an annuity, the cash value, and you wouldn't be taxed. It's a tax-deferred event. So if you had any gains on it whatsoever, then you would be able to maintain the gain. There's no cost. I would recommend probably, if you've already got enough cash for your kids, you're not worried about that, then I wouldn't pay for a living benefit or a death benefit on the annuity. I would just let that go. Those are extremely expensive insurance policies. In some cases, you're better off just hanging on to the life insurance if that's what you really want it for.
No, I mean, I'd rather be able to use it while I'm around and be able to give the kids more when I'm not. So.
Yeah, well, there's this product that's really fascinating. It's called Jefferson National. $20 a month is what they charge for their M&E charges. The industry average is 1.4%. Okay. So if you've got, say, $100,000, cost you $1,400 with a typical annuity a year.
Okay.
Theirs is $20 a month, $240. If you had $1 million, theirs is still only $20 a month. That would be $14,000 with your typical annuity, and that's just the insurance company's charges. So
so what's this called, a 1035 exchange?
Yeah, yep.
And what in essence does it do, Bill?
Well, you could transfer the cash without creating a taxable event. You're not going to get a 1099.
The cash value,
yeah,
okay.
Into an annuity. I would probably recommend for you an investment-only annuity. That's what I was talking about. You should see the number of funds these guys have. It's like 360. They got Vanguard, Fidelity, T. Rowe Price, you name it, it's in there. They've got those leveraged funds, which are hilarious. The inside of a tax-deferred annuity, you can manage the money yourself. We manage money for that in that for some people, but somebody like you could do it yourself. You get online, you make your allocations, you make your changes, and you monitor it. It monitors your performance for you. It's pretty cool. So,
well, just excuse me for a minute, but an annuity. Say if I would convert this to an annuity lasts as long as I live, correct? But should I die at age 70, then the annuity shuts off?
No, that's a type of an annuity. That's actually an income annuity. That's after you've already annuitized it. An annuity, the way that we're talking about, is basically a tax-deferred investment vehicle, kind of like an IRA, except that there are no contribution limits. You could put as much money in there as you wanted to. It grows tax-deferred. When you start to take money out, then it'll calculate a portion of that as a taxable portion, and you have to pay taxes on that. But it's also going to calculate a portion of that as a distribution of your principal, even if it were, let's say you put $100,000 in here 10 years ago, and now it's worth $200,000, and now you want to start taking money out of it.
Right.
They're not going to treat it all as return. They're going to do a RMD calculation just like your IRAs, and they're going to attribute a tremendous amount of your distribution as a return of your principal, which is tax free.
Okay, so if I would do something in this line, then if I put say $100,000 in it, I would eventually get $100,000, or at least my estate would receive $100,000 back, right?
Yeah, well, and what's really nice about an annuity is you can name a beneficiary. It will go around the probate process.
That's what I'm thinking. Yeah. May I? The other question I had, because of some of my business dealings and investments, may I borrow against it?
Not in that.
Once I take cash out of it, it's
that's a distribution. Yeah,
it's a distribution. So you can't borrow against it like a home equity loan or something.
No, they do have single premium universal variable life insurance policies that you could do something like that with. I'm not sure. It's been so long since I've looked at that I better shut up. Actually, you used to be able to do that, but it's not as it's nowhere near as common as it used to be.
And okay, I'll get to the 1035. That sounds very interesting. Yep. Next question, JCP. You still good on that?
Yeah. They came in missed a little bit, which is really funny. The stock was. And this is what, if you don't have a method today, the stock market is going to chew you up.
Yes.
That stock was down 10% before the market opened, and it opened down significantly, and then it closed higher on the day, up almost 4%.
I know. That's why I'm asking.
And that's where my phrase, that's what you get, came from. Just kidding.
Last thing is the surge in Lico, Caterpillar, some of those other companies, is that sustainable?
Well, it's all perception based on, what Trump says about the trade wars. If he starts throwing taxes out at China for a lot of their exports, Lincoln Electric's big competition comes from China. And if he's going to, wage war against them, would be very good for Lincoln Electric. But I don't think what people, portfolio managers today, they're really trying to extrapolate. You got a bunch of hedge fund managers out there who really probably shouldn't be managing money. And a lot of them have an enormous amount of capital at their beck and call. So these guys make a lot of bets, and it's not really based on anything that's happened at the company. It's based on what they perceive to happen through the Trump administration and what he might do to some of their competition.
Now, Lico is way overvalued. If you look at it,
what's its price to sales ratio?
If you look at the analysts, most of them saying it's 70 was the high point. It's approaching 75 now.
Yeah, but you got to look at the revenues, all that kind of stuff. Do a really quick, even if you just capitalize the expected earnings And I haven't done that for a long time. It's not a cheap stock. No, it's not a grossly undervalued stock. And but it's actually been at this price before. That, in the short run, like I continuously say, anything can happen and probably will.
The stock, yeah.
Yeah, you should see a lot of these small banks. I mean, they're selling at valuations they didn't even reach before the bubble burst. And I'm looking at that going, holy cow. And there's a huge dichotomy there. There are a lot of banks that are selling at extremely reasonable prices. And then you get these others that are selling. You're looking at this going, what are these people thinking? These are supposed to be professionals, because I know individuals aren't buying those. And they're pushing the prices up to a point that, there's basically, you should sell them now. That's why I was talking about at the seminar, I was going to run a screen, because it should be good for banking. The present administration was very stringent, put in a lot of regulations, probably a lot of it, some of it unnecessary. That's just what governments do. And you get a government that's anti-regulation or less regulation friendly. And these guys, I think they're all going on buying sprees. That activity slowed down significantly because they were having to deal with a Dodd-Frank and all the capital requirements, different tiers of capital. The list goes on and on and on. And you start to get rid of some of that stuff. And these guys need growth, because most of the managements of the companies are rewarded in large part on an increase in earnings. And if your earnings don't go up, you're not getting your bonus is going to be impacted severely by that. So what is, a really easy target, especially in the banking industry, is another bank. They're using they're using the same software in a lot of cases. There are a handful of vendors that make the banking software that they all use. So it's relatively easy to merge the two activities. And inevitably, they will reduce the amount of staff. Even if they didn't, it could be accretive to their earnings. So what I'm saying is there's an opportunity for financial engineering to lead to higher earnings per share, and prices typically follow that. That's why you're seeing this surge, the anticipation that a lot of that activity is going to happen. And if you're a big bank and you're struggling to grow under the current environment, which they all are, okay, and all of a sudden, hey, we can buy all these other little banks are opening up their targets now. We can accumulate them. We can roll them up within our bank because we're using the same basic software, and especially the companies that are using the same vendors. You know how easy that is to merge? Yeah. So that, this has triggered that. And right now, it's obviously what they're thinking. That these companies are all going to be taken out. It's going to be good for the companies at the top. They'll be able to grow their bottom lines. It's going to be good for the companies that are being acquired, because they're probably going to do it with some of these cash reserves they've been building up over the years by buying their stock back. All the stock buybacks that you've been reading about and hearing about, it's true. So they've really built a good position. And giving themselves the ability to use their stock as currency. They don't have to write a check for that, by the way. They just need approval from the board to exchange shares. And that works out really well for the acquiring banks and for the banks that are being acquired.
Well, Bill, I was going to just ask you, as an aside, BB&T, it's a bank down North Carolina, South Carolina, the Southern Atlantic. Are you familiar with that?
Yeah, I'd have to look it up. I just pulled up the chart on it, but it looks like it hasn't moved up quite as fast as a lot of the other really small banks. But it looks pretty. The chart looks good. The chart looks awesome, actually. But it would take me a while to go through and look at the bank. It's too hard to give a solid. No,
I understand. It's a solid bank. You may want to take a look at that when you have a moment. It's good company.
Yeah,
good bank.
I really think, though, Jerry, you're going to be way better off collecting a group of stocks and buying it through a firm like Folio rather than trying to pick one or two. Because picking one or two, my luck, I'm going to buy the two that don't move.
I doubt that. So, okay, good talking with you.
Thanks. Have a good weekend. Yeah. And you've been listening to Bill Bullington right here every week at 8. I hear the guy that means I got to go. Have a good week, everybody. Good luck and good investing.
AM 1420, The Answer. If you have a question and would like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or contact him through his website, bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and or investment strategies recommended and or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
The preceding program has been paid for by Bullington Capital Management, LLC.
The preceding program's views, claims, or representations may not reflect those of AM 1420 The Answer or Salem Media Group.